For our audience worldwide, good evening and welcome to Money Matters, here from our studios on QTV along Caraba Avenue. On today's diary, we will look at the international foreign exchange market, commodities market, and the conversation section. Today's conversation section is, as most of the audience have been requesting, that we need to bring Doctor back, for the conversation was not done, but we had time constraints. So we will continue with Dr. Keba Jame, and it's going to be an extension of the public debt and public finances, given the latest release by the Ministry of Finance. I am Malik M. Jallo, and this is Money Matters. Welcome back. We take a look of the international foreign exchange market. Dollar remains strong, but the most interesting is the performance of the pound. Is this the Rishi Sunak effect? Since his appointment, we have seen confidence being restored in the markets as traders begin to favor the pound sterling, as you would say that the pound sterling has been the strongest has put up the strongest performance alongside other currencies, the dollar and the euro. And you can see that the dollar depreciated against the pound sterling 1.37%, 1.37%, and the minimum depreciation is 0.36%. Dollar remains a little bit stable. It opened at 57.35 and it peaked at 58.04 and closed at 58.03. Euro also showing a bit of recovery as the monetary policy tightening direction is becoming so obvious by the European Central Bank in the next MPC meeting. It opened at 56.71 and it peaked at 57.80 and closed at 57.79. This really shows a strong recovery of the euro compared to the previous weeks we have seen, given its rate change or its strength against the dollar. The pound, like I said, has made the most recovery among the three currencies. It opened at 64.85 and peaked at 67.36. That is the closing. So this is a real recovery of the pound since Rishi Sunak took over the prime ministerial role and has pledged to change the course of the economy and also the direction of fiscal policy. On the international cross-exchange rates, this brings up the question, if euro is recovering, although very slow, and pound is recovering and stronger and faster, does this put question into the dollar dominance? Are we about to experience the dollar dominance fading away since the COVID-19, which has strengthened over these days given the Russia-Ukraine war? Well, there are a lot of reasons behind it, and one answer may not be right. But as we have seen over the week, is that euro is recovering stronger and pound is recovering stronger, but also dollar remain stronger. That is what we had for you on the international foreign exchange markets. But before we move on, we look at the charts. Pound opened at 1.13, it peaked at 1.16 and also closed at 1.160. The peak was 1.162. So you can see an upward pickup on the pound sterling since Rishi Sunak took over. Over the week also, the euro has actually hit parity with the dollar. This has not been the case over the weeks. The past week, we have seen dollar maintain its streak and euro maintain below parity against the dollar. But on the 26th, it hit 1.0085, but later on dropped back to 0.99 and closed at 0.9959. This is also a strong recovery of the euro in comparison of the past days. That was the foreign exchange market. When we are back, we take a look at the commodities market. Welcome back. That was the foreign exchange market. Now we will look at the commodities market. Crude oil opened at 94 and closed at 96 on the backdrop of the fact that the OPEC has pledged to cut oil supply beginning in November by 2 million barrels. This has raised a bit of fears, and we see price picking up gradually. But also this fact or this decision was supported by the fact that they believe that there is demand is spiraling down from China, and also the European Union is also preparing a package to ban Russia's oil imports. Gold opened at 1660, but it closed lower at 1645 as the Federal Reserve prepares to institute another 75 basis point hike. Dollar is becoming more interesting to handle or to hold and also to trade with, giving investors an alternative to shift instead of holding larger portfolio of gold. Rice has been on a steady decline. It opened at 1630 and it closed at 1615. That is what we have for you on the commodities market. And when we come back, we look at the conversation section. Welcome back to the conversation segment. The last time or last week, we had Dr. Keba Jame here, and he helped us understand public debt and public finance. And the audience kept on requesting that the conversation was incomplete. And even the team here at Money Matters, we felt the same. So today we have Dr. Jame back, and we will continue our discussion. And this will extend to the new release by the Ministry of Finance as they release or they give out their medium-term debt sustainability strategy. So, Doctor, welcome back for the second time on Money Matters.
Thank you very much, Mr. Jallo. Great. It is always a pleasure to discuss issues that have implications on the welfare of Gambians.
That's important, and it's good that we take that with a great weight. So where we stopped the last week, we discussed project financing. We discussed raising money through borrowing, bonds, and treasury bills and external debt. But let's draw back a little bit. Is debt in fact good in the first place?
Debt is not bad. Debt can be good, but it depends on what you use the debt for. As an individual, if I borrow money from the bank and then I go to Senegambia to spend the money, that is a bad debt. If I borrow finances from other individuals or countries and then I use the money for consumption purpose, that is a bad debt. But if I use the debt and make investments that will pay returns more than the interest rate on the debt, then that is a good debt. Because from the investment, I will recover the principal amount to pay back the loan, I will recover the interest payment to pay back the interest, and then I will be left with my profit.
So, from your experience and your training, do you think we are using the debt in the right manner in this country, in the government?
From my experience, I will say no, we are not. Because even if you look at our expenditure portfolio, it is mostly biased towards recurrent expenditures. Yeah, the amount of capital investment that we do is very minimal. Although one must recognize that over the past years, our capital expenditure has been increasing, given to the road constructions that we are doing both in urban and rural Gambia. So that is one thing that is encouraging. But if you look at our overall expenditure, it is mostly biased towards recurrent expenditures.
During our last conversation, we made mention of different financing strategy, and one of the points or one of the strategies you mentioned is why not we start issuing long-term maturities and bonds and diaspora bonds and all that. And I wanted to come in, but we were constrained by time. So today I'm going to delve into that. The Ministry of Finance has rolled out a bond program, I think for 2 years or more now, and they have issued consistently year on year between 3 to 5 year bonds. Okay, but these bonds, the holders of domestic debt in this country is commercial banks, and like you said, the chunk of this debt is not going to capital expenditure? What is the risk involved as the commercial banks or the financial system is exposed to long-term debt, which is not invested in capital expenditures that is going to finance itself? What are the long-term implications of that in a macro economy, and also the risk on the financial system?
Yeah, here we have two parts. From the commercial bank's perspective of it, that is those who are buying the treasury bills or treasury bonds in this case, they are not bothered with what the government is using the money for, as far as the bonds are commercially viable from their computations. So once they are receiving their profit from it or their returns from it, they don't care much to what the government is spending the money on. For the commercial banks, once the government moves from 91 days treasury bills to maybe 3 years treasury bonds and 5 years bonds, maybe they will also need to do their recalculations to see how profitable it is, or do they need to invest in other sectors different from buying bonds? Because buying bonds that is like armchair banking. It is the easiest sort of banking that you can do to provide returns. Maybe once the government increases the maturity of their bonds to long-term durations, commercial banks will also need to do their homeworks to see if it is very rewarding to still buy it. But in the Gambia generally, it will still be rewarding, and then you will still have buyers. Most of the times, if the government announces that they are selling bonds, it is most of the times oversubscribed. But we have some antidote examples in, I think, even this year in September, when it was undersubscribed. Yeah, but that is from the one side of it. From the other side of it, so the sustainability part of it depends on the government. What are we investing these loans on? Because it is only going to be sustainable when we invest in sectors that will provide returns. Yeah. So if you look at debt sustainability analysis, one indicator that is used to measure debt sustainability is the difference between real interest rate and economic growth. If the real interest rate is lower than the growth of the economy, that will not be sustainable in the medium term. If real interest rate is lower than GDP, then it is going to be sustainable. Yeah, because what that means is the government will take loans and then invest in productive sectors that will increase the performance of the economy as a whole. Yeah. So there are two perspectives. One from the commercial part of that is the buyer, and then the other part that is the government on the seller. So the buyer will not put much consideration on which sectors is the government investing. As far as the bonds provide returns, the banks will buy it.
Okay, I will bring in another perspective, and I want to hear how you're gonna respond to that. I am an asset manager in a bank, responsible for investments and all that, and I look at government's debt strategy, long term, and I am financing this debts by taking short-term deposits, and government is putting this monies into recurrent expenditure. So should I not be worried that if this debt portfolio continue to bulk and government and the chances of its going to recurrent expenditure still remains the same? I'm not seeing anything that's going to change that. Is that not putting me as a portfolio manager, my asset liability mismatch? And also, if let's say there are a couple of banks, 3 or 4 that are doing the same thing, because they are all going for returns. Because once government shift the strategy to long-term, short-term T-bill yields start to drop. They have 91, 182, and 364, but they all continue to drop because of the shift. Should I not be worried?
Yeah, you should be worried. You should not be worried, not primarily based on what they are spending on, but because you have this maturity mismatch. Yeah, that is your worry. You have that asset mismatch. Your assets are short-term in nature, long-term in nature, but your liabilities are short-term in nature. Yeah. So if you have that mismatch, you can find yourself in liquidity constraints in times that you will not be able to use your assets to take care of your current liabilities in case they surface. So that is That is primarily where the problem is. In the Gambia, the only long-term investor in the country is the Social Security. Because the Social Security, pension funds, when you contribute to pension funds, you are not expecting to receive those pension funds now. You only receive it after retirement. So the one primary agent in the Gambia who should be very interested in long-term bonds will be the Social Security.
But they don't seem to be that much interested, because if you look at the data, the statistics on debt analysis, you realize that it's the commercial banks that hold the majority, whether it's bond or treasury bills. So which means the participation from other sectors like Social Security is not that very strong.
Yes, Social Security were players, active players, but when the return started following a downward trend, that is when they did their recalculations and then moved to other sectors like the real estate sector. Yeah. So if the government is also going to reprofile their debt instruments, moving from short-term to long-term maturity, commercial banks will also do their calculations to see, do they need to still buy bonds, or there are other investment opportunities that is more rewarding.
From reality perspective, there are few other, as a commercial bank, there's really few other alternatives where you will want to invest, let's say, $500 million in this country. Or do you think there are?
There are, but what we have in the banking system in the Gambia is structural in nature. Why? Because, for example, the agricultural sector, it is a sector that is very viable if the banks had the expertise. But if you look at the banking system, most banks do not have expertise in evaluating the agricultural sector. They don't have the expertise in assessing risks. They can assess financial risks. They can estimate financial risks and then price it. But they hardly can estimate risks in agricultural projects so that they can price the risks and then give loans on that risks. Because one thing, this is where also the central banks comes in. Because if the government is interested in borrowing, we know that borrowing crowds out private investment. Because when the government borrows, interest rate increases, yeah, and then private investors like you and I, if you want to invest in the agricultural sector, the interest rates makes it very unbearable to borrow from commercial banks. Commercial banks will not even want to borrow, will not even want to lend to private individuals when interest rates are very high, because they know that these are signals that the default rate can also be very high. So the central banks can come in by de-risking the agricultural sector, for instance. Yeah, because these are tools that have been used in many countries. For example, Nigeria, they have this NISAL, yeah, it is called Nigeria Incentive-Based Risk Sharing Lending for agricultural sector. Yeah, what they are doing is just to increase lending to the agricultural sector or to the productive sectors or the real sectors, so that will have more that will have higher impacts on the Gambia, on the economy, and then it will also add towards debt sustainability. Because that is only sustainable if you are productive. But if you have a very unproductive economy, then that will not be sustainable. So the problems are multifaceted and they are cross-cutting. Yeah, but I believe that the central banks will come in, yeah, to encourage banks to finance the real sector.
I agree with you on that point, because if you look at commercial banks are also private institutions. They are there to maximize shareholder value. So, and also they are heavily monitored, especially these are not investment banks, they are commercial banks. They are highly regulated, especially in the Gambia. So, well, while I would like to, say that they need to play the financial intermediation role by shifting the funds to the real economy, as you said, they calculate risk and they respond to how the risk looks like in certain areas. And if I am an investor or in a commercial bank and I know that I've been monitored, I have limitations and there are risks, and not only for my own sake or for the sake of the business, but also for the owners of the funds, because these are poor people's deposits and savings. If you risk it to some extension without having, like you said, the central bank coming in and de-risking, it's going to be very difficult for them to channel. Yes. But let's shift from that point. The strategies that are being maintained by the government. I know the document, the medium-term debt strategy, is not a development plan, but it's one of the tools that finances development. Okay, one of the strategies that that they have picked, according to the 4 strategies that they have stated, is that to reduce short-term borrowings in order to mitigate refinancing risk and cost, obviously, and then lengthen those maturities into 3-4 years or 5 years, so that it reduces pressure, and also increase on bilateral borrowing and multilateral. Here is the question: if we continue to go bilateral, is that not going to have an implication on our foreign policy?
It is, because for Saudi Arabia to give you funds, you must be in the friends in good books. You must be in good terms. So bilateral external debt comes with active foreign policies, and it is very geopolitical in nature. It is sustainable. That is where we are most interested in as economists, because that exposes you to exchange rate risks, and I think we are downplaying the magnitude of exchange rate risks in the country. These bilateral loans comes with long-term grace periods, and then most of the times they are consensual in nature, because the interest rate that they give you is below the market interest rate. Yeah, but when you are discussing external debt, interest rate is not the price of borrowing. Interest rates will not be the price of borrowing. Interest rates will not be determinants whether you should take external debt or not. Your prime focus will be on exchange rates. If exchange rates are very volatile and they have upward trend like they are in the Gambia, even if interest rates do not change, the cost of the debt will increase over time, only because there is a depreciation of the Gambian dalasi. And if you look time, what the dalasi used to be 10 years from 10 years ago and today, it's very different. That also tells you that 10 years from now and today, interest rates will also be increasing. They will follow an upward trend, because we are a country that is very much import based. We don't export anything that weakens the Gambian dalasi, and over time the Gambian dalasi will just get weaker. Yeah, so that is the strategy. I have also looked through the medium-term debt strategy, and I have, for us, like if you are a trained economist and you see a report that is produced by economists, you don't only look at the numbers. Yeah, you look at the rationales, you look at the language, you look at the format even, and then you look at the techniques. What I discover, what the report shows me is you have like capacity constraints at the Ministry of Finance, because variables that are time dependent. You don't use pictures. You don't take pictures to snap them, because the dynamics, what happens today affects what will happen tomorrow, and what happens tomorrow affects what will happen the next year. Yeah, so it is time dependent. So what you need to do is, when we are talking about debt sustainability, is you need to have a target first. Yeah, the strategy gives you a target. So to achieve that target in the next 5 years, what do you need? You need to identify what are the drivers of debt sustainability, and then we know that the drivers are maybe growth, interest rate, exchange rate. So in the report, on the first pages, you have projections on macroeconomic performance. There should be projections on how exchange rate dynamics in the next 5-10 years. There should be, that is rigorous work. There should be projections on how interest rate is going to move. Given this dynamics, and then given this resource need, then you will say we will project our debt needs. Yeah. Once you project your debt needs, then you tell us what will be the adjustment part, because you should not give politicians the free will to do whatever they do. You need to guide them. Yeah. You need to guide the financing need of the government, because if you do not guide the financing need of the government, you cannot guide or you cannot manage how debt will be. Yeah. So in the report, once you see that in 2021. The present value of debt to GDP is like 77%, and the target for 2022 is 55%. That does not make, you are just dreaming. You cannot achieve that. You cannot move from 75% to 55% in 1 year. It cannot be. There is no restructuring. Given the economic realities. Yeah, it cannot be. Yeah. So, but these are things that it's like we are becoming politicians in nature.
Yes, Doctor, this is like we never have enough time to discuss these issues, and I can already see how deep you are in the issues. But just 1 minute, in 1 minute, this tells you, this from what I have heard from you, it's like the status quo is going to remain, or even be worse if real structural changes are not taken into account. So in 1 minute, can we look inwards in terms of financing our development instead of relying so much on bilateral and multilateral? Just in summary.
We must look inwards to solve the problems of sustainable debt. What we must do is we need to mobilize resources domestically, and then we need to cut our code according to our size.
And we need to bring in private funding into projects.
That is part of resource mobilization.
All right. The time is up again, and I hope you guys will not request for doctor again, because we have done our best. But if time allows us for him to come back, we will definitely bring him back. But that was from us today on Money Matters. Until we meet again next week. Thank you.